Any stocks mentioned in this video are held in the fund, may be traded at any point and not be treated as advice or investment recommendations. Views from the fund manager are not to be treated as advice or guidance of any form. Welcome back to Vantage. My next manager is one of the most successful small and mid-cap investors yet, possibly one of the least heard of managers. I'm really pleased to get Randy Barron from Pinnacle onto the program. He's got a huge fund and his performance is extraordinary. So let's go and have a listen. Randy Barron, welcome to Vantage. It's great to have you on the show. Before we get into knowing you and the fund a little bit better, I just wanted to set the scene for our audience. You're one of the biggest names in small and mid-cap investing, but relatively unknown actually to many of our audience. And with the caveat that past performance is not an indicator of future performance, I'd love you to tell everyone a little bit about the size of the fund and also the performance in 2000 year to date.
Yeah, well, Neil, we're happy to be here, and it's wonderful to see all the things that you're doing at Edison. You're right. I have built, for good or for ill, I have built a reputation as a UK investor. So what I do is international small cap, global small cap, kind of any company under 5 billion of market cap US dollars, I'll look at. And today, as we're talking, and part of the reason we're talking about 45% of my book are UK names, which coming from the US, that's pretty unique. And we'll get into the why, because that is definitely away from the benchmark. Pinnacle, the firm that I represent, we manage about $7.5 billion US. That's all long only, which is a really important thing. So no shorting, no hedging, no derivatives. We are pure vanilla stock pickers, which I guess in many ways is an anachronism, but in many ways to me feels like the future, to be totally honest. I run all of our global strategies. So I have a ADR strategy and kind of opportunity fund of various things. But what we're talking about today is my international small cap strategy that has about a little over 300 million of assets under advisement.
And can you touch on the performance as well? You had a stellar 2000, I believe.
Yeah, so knock on something, performance has been pretty good. I'm superstitious, so I'm not going to give you the number, but what I will say, last year, to your point, we were 20 points ahead of the benchmark. This year in 2021, we had 2 separate quarters where we were the best in world, top of table in what we do. And, we're recording this in early December. We're getting narrowly towards the end. We're really hopeful that that kind of trend continues. The compound annual growth rate in the last 5 years has been about 22% per annum. So it's been pretty successful.
Yeah, it's the extraordinary returns, I think, that was sort of interest to me. So before we get into how you go about picking your stocks, let's get to know you a little bit better. Tell us a little bit about your journey and how you're currently in the role that you're at Pinnacle.
Sure. I started in the business about 25 years ago. My first job was at Lazard, and I'm going to date us, but you'll get it right away because we are research with Lotus 1, 2, 3 entry. It wasn't even Excel. It was just doing all of it. And I worked for a guy named Sal Moyo, who had started with Mario Gabelli, who's a big name here in the US, manages over $30 billion. And I worked at JP Morgan, some other places, but eventually reconnected with Sal. And effectively, and this is kind of a dirty little secret, people don't know this about me, I was a telecom and media analyst for the first probably decade of my true career. What that means and how that kind of arcs to here, especially with Pinnacle, is I really kind of got my teeth sharpened on traditional cash flow. So everything that I did for the first decade was very traditional, Graham and Dodd, Buffett-esque, looking for businesses that were growing intrinsic value with a catalyst, but we were looking for real kind of margin of safety and stores of value. At some point in that journey, and I've been at Pinnacle now for 10 years in March, which is kind of shocking how quickly time goes. At some point in that journey, I had a realization that the dichotomy that we use in our industry, I don't necessarily agree with. So for example, our industry, especially in the institutional side, is very quick to say, are you a growth investor? Are you a GARP investor? Are you a value investor? And to me, especially in today's day and age, this feels like a false dichotomy. So I somehow arrived, and I'm sure we'll get into this, at this evolution. The arc of my journey is about 5 or 6 years ago, I came to realize that the melting ice cubes, which were the traditional telecom and media plays, cash flow stories that had a moat, that maybe had a yield, they made a lot of sense, but they weren't attracting a wider audience than the kind of traditional media investors who had been doing it, by the way, 20 years before that. New people weren't coming in, or if they were coming in, they were coming in for things like Twitter. It wasn't kind of traditional cable, it wasn't traditional linear television, for example. And so the real shift that I had in my career, when kind of this pronounced success that you're talking about really started to evolve, was a twofold thing. One, we started to say, all right, we're going to remove the blinders and say, where are the ideas? We're going to totally be agnostic to the sector. If it's a good idea, we're going to do the work ground up. And if it's good, we don't care what the GIC sector is. That's a derivative of the process, much as cash is a derivative. If it's a good idea, we're going to lean in. And so because of that, today, our top, ironically, only 2 telecom names in the whole strategy, and one's a data center, one's a tower company, and that's maybe 5% of the total book. Our top positions are in materials, are in healthcare, and in IT, which is pretty remarkable when you kind of realize kind of where I made my bones and how that evolved. What that means in practical terms is there's a new and nascent space called synthetic biology. I wrote the investor's guide for Barron's on the space. I've become a pretty big name in it. And I don't tell people this openly, but my worst grade in university ever was in biology. So here's like things that I never would have seen coming. But what I realized was once you get away from kind of fancy headlines and fancy terminology and acronyms that every industry has, the core thing for any good business is cash flow. So if you kind of look at company X, company Y, and forget the geography and forget the sector, and you see the arc, I mean, synthetic biology is something that I look at as the same as the internet in 1993 in terms of its potential. The other thing that's worth noting that shifted, I started running the strategy that I run about 6 or 7 years ago. And the dirty little secret on international small cap as a legacy, a vestige of the 1980s, is that 34% of the benchmark is Japan. And I spent a real long journey in the wilderness trying to get my heads around Japan to realize, I mean, we hired Japanese analysts, we did everything we could to try and get there, to realize that that was never going to be our core competency. Other people are great at it, and respect to all of it. But in our case, where we ended in that journey to what we were saying before, is I was looking for similar cultural norms, similar cultural mores, and I found it in what Churchill referred to as the Commonwealth. So I mentioned 44% in the UK. If you include South Africa, Australia, and Canada, it's closer to 50% of the book today. And the reason's pretty simple. Even if the accounting is different, GAAP versus IFRS, we can share a language, we can share a dialogue, we can share accountability, which in my business, where management and relationships is core, that becomes my North Star.
Okay, that's 2 things which I think I've learned in terms of what's brought you here. Now tell us a little bit about the fund itself, particularly the small cap fund. You mentioned it's long only. What else should an investor know?
Well, I think the other thing that's really worth stressing is that we're really tax advantaged. And the reason for that is I'm looking for companies that I can grow with. There's an example in the UK, there's a very well-known AIM stock, Renalytix. This is one of the top performing IPOs. I think it's had a little bit of a retrenchment this quarter, but up roughly 10x from IPO. Me at Pinnacle, I was their first US investor. And so last July, they did a cross list with JP Morgan and Stifel, and they're now in NASDAQ. Actually, they just reported earnings this morning. And it's been a really fascinating journey. And often people will come and say, well, Randy, you were early in this, so you must be up 5 or 7x on average. And it's not the case at all. This is one of our top positions. The average gain is about 2 to 3x. And the reason, and much like the investors that kind of understand what we do philosophically and choose to partner with us, I expect management will deliver on what they're going to do. And the only way that can happen is with the passage of time. In other words, Neil, you and I are talking, and Neil, you say, all right, I've got a goal. I'm going to pick a number, 10 million, 100 million, whatever the number is. Okay, how do I know if we just met that you're going to accomplish it? And the answer is with the passage of time. So for Renalytix, we've been in the stock for 3.5 years. Our average holding period is over 5 years. And in fact, someone once gave me the definition of infinity for how long I hold things, which is infinity is a place that's so far away, if it were any farther, it wouldn't really matter, right? Yeah. So this is the anathema approach to quarterly flips. Yes, I care about earnings. Yes, I get graded monthly. But the truth is, I'm looking for things that can compound over time, and been fortunate to find a couple of them.
Interesting. And just touching on that, so when you're looking at that sort of time horizon, do you start gently and then continue to build positions, or is it, yeah?
Yeah, and that's exactly right. So I jokingly tell people, you know, I say, the most important question in my business, our business, is not what's revenue, what's cash flow, what's net income. I mean, to be totally blunt, this is not rocket science. A monkey can go down a P&L and figure it out, right? And one of the really interesting things in my business is people kind of roll their eyes or laugh when I describe what we do for a living as artistic. In other words, you can do a tracking model very easily, right? Let's say you do 2019, 2020, 2021. But how do you look out into the future? 22, I know Edison does this really well, right? 22, 23. I mean, this is the art of what we do. And in my instance, the question that really matters is not what's cash flow and what's your top line growth. I can determine that pretty quickly. The question that matters is, are you going to be able to accomplish the goals that you set out to do? I mean, the hokey way of saying it is, are you a good person? Can you live up to your word? So I once said that to someone. They said, well, even a sociopath would say they could do it, right? They maybe would hesitate a little shorter before they said we can do it. But the only true way to know is with the passage of time. So Renalytix, a great example. We dipped in, we nibbled in a little bit. We watched it run. We said, oh, they're executing, they're building this plan. Let's lean in more and more and more. And I kind of feel, again, it's just what I'm comfortable with, but it feels a really prudent way to invest. And by the way, certain of my investors do that with me too. They say, we're going to give you, pick a number, $500,000, see how you do. Let's just tip it here. And then when you deliver over time, and when you have communication, because for us, relationships with management, the same as relationships with client, that's why we're in this business, to be able to explain kind of all of these ideas that we're finding. Over time, it tends to really kind of compound and work out pretty well.
Yeah, look, it's a great segue into actually talking about your investment approach. And in particular, I mean, every manager I talk to, of course, has an approach. I think one of the things I'm trying to dig for is, what do you think gives you an edge? So let's start with, I mean, I get the bit about you're looking for opportunities, you build positions over time. You've got a certain time horizon. What else should we be thinking about when you're looking at your investment approach?
Well, the thing that I'm probably most proud of, because it took the longest journey to get there, is the movement away from fossilized thinking, which I think is something that really in our industry overall is a legacy thing. In other words, you have an approach that worked well, maybe it worked the second time, so that's all you're going to do, right? Yeah. And because we get paid on performance, you're scared to go outside of that lane. It took me a long time to get comfortable kind of with what I call maverick risk, which is to say, like the maverick from a herd going away from a benchmark. How comfortable are you living in that world, that kind of satellite universe where you're not market neutral, right? You're making a convicted call and decision to say, I believe in this management and I believe in this company. And that journey, which essentially is a blinder, right? I no longer look at it to say a screen, right? Bloomberg screen, top down. I'm only going to look at a tower company in South America. And I mean, it didn't seem intellectually a really valid way to go about it. And where I have found success is kind of almost covering the top sheet of the 20F or the 10K or the equivalent annual report, and just opening it up and reading and seeing if it resonates, and talking with people in industries, talking with people who I've invested alongside and say, hey, what else are you seeing? And 9 times out of 10, it's a journey that you take that is really exhausting and ends up nowhere, right? You're in the mine shaft and there's no gold.
Yeah.
But 1 time out of 10, you get maybe 2 to 3 of these great ideas a year. I'm okay with that. And it took me a long time to realize, to take a step back to say, if I only find 2 ideas a year, it's okay, right? Because when we were all young and starting out, every day you wanted to generate something to show that you were creating value. And I realized over time that you can be a value adder doing less versus doing more. Not less work, but less fiddling, less kind of nuancing. Let things roll. And over time, especially from a long only perspective, right? You need to be super optimistic. I mean, I'm not a debt investor, right? I'm not a pessimist. I'm here to tell you the future is good, right? I'm an equity guy. And that is kind of what's really interesting, because managements tend to really respond to that, right? I'm not going to run for the hills when, not if, when you have a quarterly miss, because it's going to happen. We've all been there. It happens. Supply chain happens, your ship gets stuck off of a port. You can't control that, right? These are exogenous events. And why should I penalize you? As long as I can explain to my clients why I'm still holding you throughout. And kind of a feather in our cap is when we go back to the end of 2019, in other words, before COVID, to today, December 2021, 80% of our top 10 names are unchanged.
Okay. Wow. Okay. That's so that's telling us the long-term nature of the investor, the fact that you're a sticky investor, which is good. I mean, I think corporate management teams, are looking for that kind of individual. I think the maverick bit is interesting because, I wrote this IPO piece recently, and one of the things I reflected on is the fact that we've seen outflows from UK equities for the last 4 and potentially it'll become 5 years, and it'll become 6 years if in the current. And you're going against the herd. You are investing in UK names. So you've in the past talked about the fact that a major contributor to your performance has been investing in the UK. So what attracted you to invest in the UK?
Someone once gave me they were just talking about kind of how things since Brexit, right, in the 5 or 6 years since the vote, the UK has been a pariah, right? I mean, effectively. And I know we don't lead with this, but it's true. Like in the global market and capital markets, if you compare the S&P in that period, roughly 2x. S&P more than doubled, FTSE or whatever subsection you want to use, had some growth, but nothing great. There's a lot of reasons for that. People don't realize that the S&P has now, especially with the FANG stocks, become 40% tech. Compare that to, which I believe is 2 or 3% tech, right? And so the UK is not known for, let's call it, the growth names, which I think is really unfortunate. The example I always give is Zoom. You and I are on Zoom right now, right? Zoom existed before March of 2020. None of us used it in a real way, right?
Yeah.
And totally changed industries, right? It's going to change conferences going forward. Investment bankers will never have to go on as many flights conceptually. That type of dislocation of a market to the positive has really benefited stocks in the US, right? They kind of created all these things. Those same type of innovations exist elsewhere in the world. And one of the interesting, I talked about fossilized thinking, one of the interesting things that I've really been on the mountaintop kind of preaching about is we need to look beyond the US for the next iteration of ideas. Just to give you some frame of reference there, and I'll come back to why the UK. When I started in this business, there were roughly twice as many, round numbers, 10,000 US publicly listed names. Today, because of M&A, because the unicorns never needed to go public as quickly to access the capital markets, that number is less than half. So I don't think that trend abates. I think it continues. And so the way that I position it, and here's the part I don't know. I don't know if it's 3 months from now, 3 years from now, 10 years from now. But I view it as inevitable that the arc of investing, especially to those that sit in the US, which is where I'm coming from, I think they're going to inevitably have to look abroad to find ideas, especially in the 11th or 12th year of a bull market where the US market has done so well. When they're looking, what value matters, right? I have a company and someone pitched me 100 and something times revenue. That's not a real multiple, right? And so I'm not saying today it's the end of the cycle, but certainly it feels long in the tooth. And so I'm comfortable. Part of the reason I love the UK is, you know, if you're doing an AIM listing, for example, and I do a lot of testing the water meetings with these companies that are looking to list and all this stuff, net cash on your balance sheet, right? AIM has no appetite for 3 to 5 times gross leverage. So think about that. If I have a choice between an equivalent business, maybe it's earlier stage because it's going to do AIM, right? On the equivalency of it, you know, if it's 3 times levered in the US and 1 times net cash in the UK, and I think I'm coming long in the cycle, wouldn't you be more comfortable kind of having the safer balance sheet conceptually? And no one really thinks of the UK in those terms. A really interesting trend that's happening right now, which the media is just starting to pick up on, Barron's is going to do a piece on this, is the number of US, especially in life science, the number of US based companies that are choosing, instead of going a mezzanine financing route or a venture route, they're choosing to access the capital markets in the UK via the AIM, which historically has been kind of frowned upon, but that gives them an opportunity to access capital without having the headache of being, you know, a company kind of owned by a venture firm, which is a terrible board meetings, 3-day board, it's just a nightmare. The other thing is, people don't realize this in the UK versus the US and why these companies are looking there. You don't have the same quarterly filing requirements. That will change, right? Transparency is only going one direction. But as of now, if you're a US company listing in the UK, you have 2 reporting cycles per year. So let's take up numbers. Let's say you're 10 million a year revenue, you're $150 million market cap company, and you're choosing to list there. You get 30 to 50 million in your raise, right? Which is a success, fund your business. But on this 10 million of revenue, you only have 2 reporting cycles. So you've cut out the lawyers, the accountants, all the people that want to kind of get in and reach into your P&L. You probably save between, in US dollars, $500,000 to $1 million a year, which again, on 10 million in revenue, that ain't nothing. That all flows right through to cash flow. And in so doing, you also get introduced, like Renalytix was a great example. They got to spend 2 years in the public markets being accountable to what we talked about before then coming cross-listing to the NASDAQ, which is what they did. And so that trend has really continued. And what I have found is that the level, at the highest level of conversation, when I talk with managements, they prefer kind of the US institutional investors because we're not scared of certain things because of that history we talked about. We will ask questions, we will go places that the traditional UK fund maybe wouldn't. And so that's something that explains why I think the UK has really become an unheralded proving ground for global capital markets. You don't need to come to the US, you go to Hong Kong, whatever. But the point is, it's something that's really bubbling. And part of the reason I've had the success that I have is finding these companies early and then staying with them.
Yeah, and I know that a big part of the London Exchange's drive is to try and get more of these sort of growth companies onto it. And of course, you need investors who can appreciate those growth companies. And that is one of the things that I think has stood out in terms of when I look at the things that you invest in. His strategy is identifying unappreciated growth. I'd love to know a little bit more about, how you go about doing that. And of course, if you can illustrate with a couple of examples.
Well, that's the secret sauce. So I need to be careful, but it's not really that complicated, right? I've been in the business a long time. So you have people that you've invested alongside. So the way that we source ideas is pretty simple. Friends and family, PMs, or whatever you want to call it. You have these dialogues and conversations, and they say, hey, I'm doing work on this company. I think you should take a look. I'm known for there's a Chinese-based data center called GDS. GDS is a Hong Kong listed and NASDAQ listed. And about 6 or 7 years ago when they came public, it was a broken IPO. $12 stock, fell down to $7. And I met them at this time because RBC has a telecom analyst who I've known for decades.
Yeah.
And invited me to this lunch with the CEO and CFO. And we're sitting there and they were lamenting their stock price, right? Too often, management teams get caught up in the day-to-day mark-to-market movement of a stock price, when in fact, they should just focus on their business. And if you grow intrinsic value, the rest will take care of itself. In the case of GDS, and they, to this day, they still remember this. I sat there at lunch and I said, guys, you should embrace this moment. Remember what we said before, being positive and looking for the opportunities. I said, you know, your EBITDA margins are 50% plus, you're growing at 40% top line year on year. You are the contracted data center for Alibaba and Tencent, meaning I know Alibaba's at a 4-year low, but if you believe that China is going to have an internet, GDS goes with it, period.
Yeah. Yeah.
And so I said to them, instead of lamenting a broken IPO, lean in, buy more personally, right? Take a bigger stake, and they did. Anyway, the stock ran, we sold in the 80s, ran to 114 in February of this year. This year, because of Evergrande, when I mentioned the 2 telecom names that were in, we were able to re-enter this name at $50 a share, having, 4 months earlier been, like I said, at 115. But that same cycle, that same analyst from RBC who had kind of introduced us to GDS called me up about a month and a half ago and said, Randy, I know, and by the way, Neil, this probably comments about me as a person more than anything else. I love broken things. And so he said, Randy, I have another GDS type equivalent. I think you should take a look. And this is a tower company, a London-based tower company, IHS, that has 75% of their revenue in Africa, right? And so here's political risk. People kind of don't look at it. But when you look at the business, are you going to, at this day and age, what are you going to disconnect first? Your food or your cell phone, right? I don't think that's a profound comment. Most people we know are going to keep their phone and they'll starve, right? Yeah. So 60% EBITDA margins. I mean, this is the kind of business you want to put in a drawer and just let it grow, right? Yeah. And by the way, IPO'd at $21 a month and a half ago. I'm buying it today for $13. I mean, that's, for me, and the whole industry trades at 30 times cash flow. I'm paying 7 times EBITDA for this business. Like, for me, I'll do that all day. So that's kind of an introduction. The other kind of atavistic approach that I use, and you can't laugh at me for this, is I read the physical newspaper. I literally, I'm looking at my desk here as we're talking, and there's physical papers all over it, because what I look for is in the Wall Street Journal every day, they give, the top 5, they give the top 10, 15 gainers and losers on every day. And it's a global database, includes ADRs. And often there's reason things are losing. There's reason things go down. But sometimes the market, is irrational, right? The market's never just right. It's euphoric or it's manic. And our jobs as portfolio managers is to sell when it's euphoric and to buy when it's manic. And as long as you don't get caught up in those waves, those undulations in a kind of Sylvia Plath bell jar type moment, it's a good filter to use. So anyway, I use the paper as a screen. I use friends and family as a screen. And what was interesting to what we're talking about before is how often a lot of those people were saying, hey, here's some really interesting things happening in the UK, and you should take a look. And by the way, not in mining, not in the traditional kind of UK sectors, the finance, the things that the UK was known for. And the quote that someone said to me after Brexit was, yeah, it's a dark time in Wales and certain places, but even mushrooms grow in the dark.
I want to talk a little bit. I mean, you mentioned the fact that, because I think this illustrates this idea of underappreciated growth. So biosynthesis as an industry has been around in various guises for a while. But like any industry, there comes a point where the market opportunity and the maturing of the technology is at this sort of interesting sort of cross point in time. And I think you were quite early in picking it up. And I know this because I've seen, I've seen management teams who have been thinking about sort of IPOing and the level of knowledge that you have is in that particular space happens to be just further ahead than perhaps other markets, etc. So I think that's an industry where you've clearly done a lot of work to get yourself up the curve. So I want to understand that a little bit, and maybe you can talk a little bit about how you also invest in that space.
Okay, there's a lot to unpackage in that, and synthetic biology or biosynthesis, as you say, is something that we could spend a whole different hour-long podcast on. So I'll try and not go too deep into it.
Yeah.
You're right. I was early in the space, and I'm known in the space. And in fact, I have some friends that work in the UK on the sell side. And as they're working on their models, you kind of, in our business, it's very easy to put the blinders on and you're working. You don't realize kind of that you've built this knowledge database. But I have a friend that works for one of the banks in town who called me and said, walk me through the model. Where am I wrong? And her gross margin numbers were totally wrong, by the way. And I had to walk through and explain as to why. Synthetic biology, to your point, has been around for decades, right? But what's happened, I mean, the most kind of the big name in the space is Amyris in terms of revenue. They have about 400 million in revenue this year, which is more than the rest of the space combined, relatively. And Amyris has been public for roughly 2 decades, a little under 20 years. What's interesting is there have been other synthetic biology companies that were public in that same time. Often what they said is, all right, we're going to try and solve the problem of fuel. In other words, fossil fuels are destroying the earth. We all know this. That's why electric cars are doing so well. How do we replicate it or solve it? And so in this case, they made petroleum. They all did. The problem is at that point, now I'm going back over a decade, the cost of oil went from $100 a barrel down to 30. And by the way, small batch production business, you're out of business. It's done. So Amyris is the last man standing. Ginkgo, Ginkgo, the largest SPAC of the year, $17.5 billion special purpose acquisition corporation, symbol DNA, which is a wonderful symbol and has totally captured the zeitgeist. Their tapestry in front of the exchange the day they went public was a jungle with a T-Rex sticking its head out. And the motto was make anything, right? And I said to somebody, and by the way, this company trades at over 100 times revenue to what I said before. I said, if they can make dinosaurs, this is cheap, right? This is like, we're going to do it. And people look at it and they say, it's the next Amazon AWS and all the disruption. The reason that this is the real moment, kind of that hockey stick moment for the industry is you have, in addition to the 20-year history of biology, you have CRISPR, you have AI, you have big data. You're able to kind of create the evolutional cycle a little bit quicker than historically we've been able to. Because we're not skipping biology, by the way. We're just accelerating biology, which I think is missed on most people.
Yeah, so it's that sort of convergence of technologies, etc., and a market that is looking for solutions at the same time.
Well, so you're starting clean, right? And so a lot of the stuff that synthetic biology does is clean. Like people don't realize when you take a vitamin every day, that's petroleum based for the most part, putting it in your body. And you actually take a step back. Most shampoos have silicons in them. Silicons do not flush out into the ocean. They don't biodegrade. And so if you actually took a step back, and I'm not making this as a huge claim to say everyone needs to be socially responsible investors. I don't necessarily agree with that. I think you can play the cycle on oil and other things. However, I think all of us would agree as kind of thinking individuals that we want the earth to exist for the next generation and the third generation and all kind of that garden of forking paths. In this case, synthetic biology allows the creation of goods that are created cleanly with clean chemistry at essentially the same price point as what exists in the market today. And in some cases, even better. Edison recently had a panel, and you can certainly link to it in the notes, on cannabinoids and synthetic biology. And I was fortunate to be on that panel. And one of the things we talked about was the fact that everyone today knows CBD, cannabidiol. Well, CBD, so when I grew up, like if you had an injury and you're doing sports, in the US, they had Bengay was the big thing. And it smelled terrible. It was a topical, got deep heat into your ligaments, into your muscles. Today, if you go to the Tesco's of the world, you go to the supermarket, you get the topical cream with CBD on it. But because of rules in the US and in the UK where you can't have certain thresholds of THC, which is a psychotropic part of cannabinoid, the actual amount of CBD in those bottles is de minimis. If you actually take it out to, because it left the factory 3 months ago and they worried about not having a business, so they didn't put as much in as they should have. So today, a price per kilo of CBD is roughly $1,200 US dollars at $1,400, roughly. There's been a bit of a glut of production. CBG, which is 2% of the cannabinoid plant and about 10 times as efficacious when it comes to actual use in topical creams. The synthetic guys like Willow Bioscience, Creo, Amyris, Kronos, which is ginkgo backed, they're going to be able to produce CBG at roughly $500 a kilo. So what I'm saying to your audience today is, here's a great example. CBD is the known entity today. CBD is going to be wiped out because CBG is going to be produced at 1/3 the cost. So I don't understand when that happens. It could be 10 years from now, 5 years from now. But I do know that at scale, because CBG is going to be made in a lab, it's going to be cleaner. It's not going to have any THC overlap. It's the future. And the only thing I just don't know is the when. And so for someone like me, as I mentioned before about my holding period is conceptually infinity, you know, we sit and we wait and we watch it and we track it. And the fascinating thing, people talk about Moore's law, you know, with chips. The clean chemistry revolution is growing faster than that. And no one up on it.
Yeah, so that's a great, I think it's a great example of, you know, a sector which a lot of people don't understand. And if you get your head around it, there are some tremendous growth opportunities there. Talk to me, I mean, growth companies often need growth capital. Talk to me a little bit about how you work with management teams. I mean, you talked about gradually sort of building up positions. How do you work with management teams in terms of supporting them with growth capital? And if you could touch a little bit on your pipe activities as well, that would be interesting.
Well, yeah, and I should have mentioned that as a corollary before. So just to rehash what we said before, you know, we invest over time, over a period of years, right? A little bit, a nibble to start, and then we grow in. And because we're long only, meaning again, we don't short, we don't derivative, we don't use leverage, we don't lend out our shares, right? So no one is shorting the shares that we own. I'm probably missing an opportunity, right, of income on that, but I think it's more important to support management and to say, we are in your corner and we're going to support. How that manifests in the real world, because also I'm not bothering management, right? You're the specialist in synthetic biology. I'm just the investor kind of allocating capital. And therefore I'm going to check in, you know, maybe once a quarter, maybe a little more if it needs to be done. And we're going to probably have a pretty positive conversation about the future. I don't really use red letter words unless something really, really bad happens. And then you probably don't want to take my call because my vocabulary is robust and like a sailor. But the point is, when managements need growth capital, Neil, to your question, we're often one of the first people they call. And how that's manifested in the last couple of years is through these pipes. So PIPE stands for private investment in a public equity. We only do public equity. So I'm only going to invest if there's a security that trades publicly. And typically they'll say, all right, we're doing a round. We need, pick a number, 30, 50 million for this purpose, right? We're building a factory. We're going, Seeing Machines just did one a week ago where they're going to be in a whole new series of car lines, including the Ford F-150. And they need to, like, that's a great example of growth capital. I mean, I was on the phone with them for 10 minutes. Again, I've known them a long time. So the CEO, Paul, I'm in. What do you need? And this kind of virtuous cycle, going back to what we said before, of why I think kind of long only management has, as much as an anachronism, it has a future. It's because managements are really tired of the, let's call it emotion of the market, right? The day-to-day traders that, especially in this year of the meme era, right, where the day-to-day trader has kind of taken over the oxygen in the room, there's still 80% of the market that's traditional, like me. And so if you can kind of get away from the headline noise of the meme stocks and all the kind of people pounding and say, why am I down today 3%? You get to kind of take a step back, get some breath, and then you start to look out 3 to 5 years, which I would argue is kind of what most CEOs should be doing with their time, thinking about how do we compound shareholder returns over time. And if you're reacting to every fire drill at any time the market's down 3 to 5%, which happens, you're really missing that opportunity. So pipes are an opportunity. It's not something a lot of people in the US have done, but I think it's going to be increasingly common. Going back to what we said before, money is still cheap. And as people can access, the traditional 60-40 equity bond diversification is no longer relevant at a point where interest rates are under 2%, right? Yeah. So I think equities have a future, have the future. And I think growth, if you can get value or growth stocks at value prices, that's the kind of concept you put in a drawer, you don't worry about it. That's kind of becoming the new T-bill, right? Going back to what we said about the AIM stock, if I can get a net cash balance sheet, there's 0% chance of it going bankrupt. Do I really care how it's marked on April 13th versus May 17th? You shouldn't, right? You're just, all you care about is where's that intrinsic value growing over time. And I think in part because the media loves the story of the meme era, like it's fun to watch, right? I certainly kind of look at it and like, these are crazy trends. You forget that good capital allocators, especially in a low interest rate environment, are still going to allocate capital really, really smartly. And it's funny, we're the tail end of the cycle. I'm still seeing a lot of potential. There's a great UK listed company that had ironically been on the London exchange and downlisted to the AIM, and they've grown so much. This Victoria, the carpet company. Yeah. BCP, right? And Victoria does all of the rugs for Buckingham Palace. That's not the reason we invest in it. It's just a kind of really cool thing about it. But the truth is, their chairman, Jeff, only pays himself $60,000 a year, and his entire alignment, he eats his own cooking, is through shares. So if I benefit, he benefits. And by the way, Koch Industries, this huge US private company, does not invest in public companies, has now done a second round of preferred security and equity with this company because they realize they're such good capital allocators that they're leaning in. So we like VC.
That's good. I mean, I like the alignment. I feel like, we've really unpacked quite a lot. I've got a much better understanding of, how you approach life. We're human beings by nature, and I always like to wrap these things up with a human interest question. So look, if it's the one of wisdom. If you look back at yourself 10, 15 years ago, what's the one piece of advice you would have given yourself, one bit of knowledge you would have given yourself, knowing what you know today?
Well, that's a very broad question. I'm going to limit it to the business, because if we went on the personal, there would be a lot that I've learned. I think from the business side, the most important lesson I've had is don't look at the tick of a stock on any given moment. In other words, it used to be, you knew what you owned. That has not changed. But if you get sucked in, it's kind of metaphorically when people have their trading accounts on their phones, like you should look at it all the time. If you're a doctor or you're a lawyer, go be a doctor or lawyer. Let people like me in the mud worry about it. But the lesson I've learned is don't feel good or bad about yourself based on how a security is traded, right? Like if a stock's up, you feel, oh, I'm the greatest, right? If a stock's down, you're like, what am I doing? Lamenting everything. I think the North Star of knowing what you own and finding companies that kind of compound intrinsic value over time. I'm seeing it today, and certainly the performance has reflected that. I'm seeing with a level of clarity that I kind of wish 10 or 15 years ago I could have gotten there sooner, because I think it would have been a lot less agita in my life, in my wife's life, in my kids' life. The concept of know what you own, pick that lane, stay in that lane, and don't listen to the noise. The noise is going to happen. You can't control that. What you can control is the company kind of being successful through it, and can you support that company in their efforts to grow?
It's a very Warren Buffett-esque way of wrapping up the conversation. Randy, it's been a huge pleasure for me to be able to talk to you. Thank you very much for doing Vantage, and we're looking forward to what 2022 brings for you.
Thank you, Neil. I appreciate being here. Have a great day.
Thank you.